Right, good afternoon, everyone. My name's Andrew Bonsall, and I'm privileged to lead the single-family business at Fannie Mae. And I'm really excited to introduce our next panel titled, Can Technology Revolutionize the Housing Finance Industry? I started at Fannie Mae back in 1992, so if you're doing the math, that's 26 years ago. And shortly after I got there, we rolled out a new innovation called Desktop Underwriter, which was our automated underwriting system. And at the time, it was billed as a revolution, but looking back, it's been more of an evolution. Our industry has been very slow to adopt technology, but looking forward, I never have more believed that a fully digital mortgage is actually possible, but let alone in our reach. So today, I'm excited for the panel. We have a great group of panelists to come and further explore those possibilities. So let me introduce them. So Nima Ghamsari is the CEO of Blend, which is a technology company that helps lenders digitize parts of the mortgage lending process. Also, Blend is a great partner of Fannie Mae in our data validation service, which you may learn about more. Jiwan is the CEO of FinRegLab, which is a startup in the blockchain space working on a decentralized network for identity and credit. Melissa Koide is the former U.S. Treasury Department Deputy Assistant Secretary for Consumer Policy and is currently the CEO of FinRegLab, which advocates for safer and smarter use of technology and data in financial services. And our panel today is moderated by Laura Kusisto, a staff writer for the Wall Street Journal covering the housing and the economy. So please join me in welcoming the panel.
So thank you so much to everyone for being here and to all of my panelists. I think this is a topic. I've covered housing for about 7 years. There are things that I think or tell myself I know everything about, and things that I still have a lot to learn about. And this is sort of in the latter category where I feel like I've barely scratched the surface of what's going on with innovation in the mortgage space, understanding it, what the implications of it are. Is it just going to make it a day faster to get a mortgage, or is it going to mean that you can get a mortgage in a second? Who knows? But I think we'll have a really fun time talking to some leaders in the space who are here with us today and who bring totally different perspectives. So I wanted to start off by asking each of you if you can talk a little bit about kind of where you were sitting before you did this and what made you think, there's something that I can do to make this mortgage space better. There's some way that I can change it. There's something missing here. So Melissa, maybe I'll start with you.
Sure. Well, thank you for having me, the entire team who's put this event together. I have to say this is like one of the sexiest kind of housing events I think I've ever been to, so very cool. And so I guess I would start off by answering that because it does harken back to, I spent 4.5 years leading the Office of Consumer Policy at the Treasury Department. And part of my office's responsibility was actually trying to dig down and understand what are the potential benefits and potential risks associated with the use of new technologies and data in the financial system, particularly the retail financial system. But now I'm going to say something that's going to make you say, why is she up here on the panel? There are enough chefs in the housing cooking space. I am not a housing expert, but do spend a lot of time and was responsible for spending a lot of time really digging in and understanding those considerations about tech and data in retail financial services. We met with hundreds upon hundreds, I realize I'm losing my mic here, of stakeholders, whether it was folks in the industry or consumer advocates or other colleagues across government, really to try to solicit what does the use of tech and data mean for consumers ultimately in their daily lives. And there was a lot of ambition and positive expectations about what data and tech could do for consumers. And there's also a heck of a lot of skepticism about ultimately how it will affect consumers. Are we sort of stratifying people in ways, leading to risk-based pricing that ultimately may hurt some consumers? And so that experience ultimately was one that helped to form what we're doing at FinRegLab, which is ultimately, because much of the input we were getting to ultimately develop our policy positions and our regulatory positions, that was based on, frankly, hundreds of biased perspectives. We didn't have any independent research entity that could actually dig in and ask some of these policy-relevant questions and test out those questions in a way that would ultimately help to inform policymakers. And so, leaving Treasury at the end of the Obama administration, I set out to build this new organization that is actually running experiments, looking at and asking with partners, but empirically answering questions about what does it mean when we bring in new types of data into our financial system. And that is actually why I'm sitting here with you all today, because we are specifically looking at a type of data that I think we all believe may be quite advantageous for better credit risk assessing consumers, both for a variety of different types of credit, both for short-term small dollar credit, but ultimately that may be useful for the housing market too. And that is, frankly, the information that we are all sitting with in our bank accounts, what we call cash flow data. And so that's the type of the evaluation that we have underway right now. And so I'll get into that a little bit more.
Sounds great. Adam?
Sure. So my co-founders and I spent 15 years innovating within financial services. And what we were really doing was developing financial technology companies and specialty lenders. And it was in that capacity that we observed a system that mediates the gathering and sharing or non-sharing of consumer data that was broken. And it was broken in a number of very meaningful ways. The first is that the system itself is not secure. We all know that post-Equifax. It's also a system that's broken in the sense that lenders that would love the benefit of sharing information among one another to prevent fraud and other types of issues are not allowed to do that for a variety of reasons. And as a result, they actually give away their hard-earned consumer data for free to centralized parties like the credit bureaus, only to repurchase it in synthesized form. The credit bureaus actually create no data, they just aggregate it and resell it. We saw a system that was broken in the sense that it has very limited transparency for both lenders and consumers. And anyone who's ever contested a credit report's likely aware of this. Similarly, we saw a system that was broken in the sense that there's a very high incidence of inaccuracy in terms of credit reports as well. We wanted to do something about that. Perhaps the biggest sort of aspect of this that we found that was broken was that there are huge portions of the population in this country that are called or considered to be thin file. And let me explain what that means for those of you that don't know that term. Thin file means these are customers that either don't have a credit score or have a very low credit score because they have very little credit outstanding. And for those of you who have Credit Karma or anything, or have looked at your credit reports, you likely know that your credit score, which is necessary for you to interact with today's modern economy, is a function of how much credit you have outstanding and the diversity of credit you have. And so imagine for a moment that you don't have any credit. You're locked out of the system. You're caught in a vicious cycle. And so as a result, literally 45 million Americans are either thin file or no file. And therefore, they have no access to credit, including affordable housing finance. And when we were building some of our near prime and other type of origination businesses, we would bump into these types of customers, and we couldn't lend to them. And what's amazing in particular is that a lot of these customers live somewhere. They pay rent. They likely pay their auto insurance bills. They likely pay their FiOS bills. They probably pay for Netflix. But none of that data ends up at the credit bureaus, and yet they represent actually, a performance history. And so we thought, again, the system was broken because data exists that could fundamentally alter the access equation for housing finance. And we thought that was crazy. So at Spring Labs, we're developing a network that does two things. The first is it allows financial institutions and others the ability to exchange information directly by addressing the historical frictions that have prevented it. So it allows them to do it in a way that's secure, that's regulatorily compliant, and in a way that addresses the competitive sensitivities that were some of the historical frictions for sharing. And in the process, because it happens to use some novel technology called blockchain, it creates the incentives for much broader participation. And as a result, some of these alternate forms of data that might exist for these so-called thin file consumers, 45 million Americans, we might be able to allow lenders and or parties like Fannie Mae, frankly, the ability to finally underwrite and provide affordable housing finance for this portion of the population, which is quite large.
Nima?
Hi, I'm Nima from Blend. Before I started Blend, I was fortunate enough to be working on some of the biggest portfolios in mortgage lending just after the crisis. And the realization I had was everything was still being done on paper. A lot of the data that these folks were talking about wasn't really being used in its purest form, and it meant that there was a lot of asymmetry in the system, a lot of waste in the system, a lot of friction in the system. And what I saw is this is really data technology, but in Silicon Valley isn't really paying attention to it. I wouldn't say it exactly, I wouldn't say it caused the crisis, but having that asymmetry of information, I think, was a contributor in a lot of ways. The fact that everything was done on paper. And so we set out in 2012 to start Blend. Our goal is to use data across, we work with 150 financial institutions and growing. Our goal is to use data to make it simple and transparent for people to apply for mortgages, ideally in one tap for any consumer across any data source. And we process about 1 billion a day in mortgage applications today.
So Adam, I was going to ask, so on the plane here, I spent a lot of time reading and rereading articles about blockchain, and I decided it was finally time to understand it. And I think I understand about 40%, which is a lot better than I was doing before. But try to give us sort of, for I think a lot of people here are probably like me, give us a sense of how it works and how do you make money off of it?
Sure. So the first thing I would say is a lot of times people hear blockchain and they hear cryptocurrency. And they're related, but they're different things. So blockchain is the underlying technology that powers cryptocurrency. Now, regardless of what your views are on cryptocurrency, the reality is that blockchain technology can be a tool for addressing real-life sort of like problems, especially in areas like financial services. Blockchain itself is actually a combination of technologies that have been in existence for a very long period of time. On the one side, something called distributed ledger technology, which I'll explain in a moment, and on the other, cryptography, which is basically sort of codes, effectively, for encrypting sort of data. And so it's this combination of these sort of two tools that enables a few things. The first is it enables much greater security. You don't have a reliance upon a single trusted authority, a credit bureau, for what is truth, for instance. You can have a whole series of decentralized nodes. Those nodes could be different financial institutions or insurance companies or brokerages or social media companies that have touched each of us. And so as a result, they can come together and establish in consensus what truth is. And so that's the notion of sort of distributed ledger technology. And on cryptography, it's really about just security, right? It's about, whether it's symmetric or asymmetric cryptography, it's about security. And so when we think about our business model, we're simply using blockchain as a tool. It's not sort of a marketing gimmick, it's the intel inside. And really what we're using it for is to create a network that allows institutions, such as financial institutions, to exchange information directly in a way that, as I mentioned, is more secure, is regulatorily compliant, as well as addresses competitive sensitivity. And the output of that, we hope, is that it leads to much greater security, much greater accuracy, and much greater transparency. And the types of applications that could be built upon this network, right? What are the products, right? There are things that could lead to much more robust identity verification, much better fraud prevention, especially newer, more pernicious forms of fraud, like synthetic identity fraud that people may not have heard of, but it's something that's growing very quickly. And so we think there are a whole slew of applications that can be built on it, including, by the way, alternate credit bureaus that have all new inputs to address issues of access, like the one we were chatting about before. So our business is about creating the rails of this network and then allowing ourselves, we're going to build some of these applications or products, which will be launched early in 2019, but also will enable others over time, once we make our public launch next year, to actually build applications in their own markets or in their own verticals or industries.
And after you launch, I mean, how long do you think it's going to take to get to be profitable?
Great question. So we intend to launch our first products during early 2019, probably the first half of 2019.
You're busy right now.
Yeah, we're very busy. And the first two products are really going to relate to fraud prevention and identity verification. And the reason for that is we have a chicken and egg problem, right? We need to develop scale technology and then drive adoption. And that's not an easy thing when you're developing a network. And so we need to focus on products where we can do things that are much better than the existing offerings in the market today. And so in those areas, we think we can develop products that are vastly better than what's out there. And we can do so with market participants that we have already identified that have clearly identifiable vexing economic problems. And we've already contracted with a number of those large actual lenders who are going to be the users of these initial sort of products effectively.
Actually, Nima, let me ask you. You guys have been around for 6 years. Are you guys profitable?
No.
What have been sort of the barriers to that?
I think it's just, when I look at the space, there's so much opportunity to, like you look at the tech before 2012 when we were founded, there was so little investment in tech for financial services. And so like there's a lot of hills to climb here. And I think just to take a step back real quick for the audience, there were a couple things that were surprising to me as we grew that I think, because I always felt like that, if we're able to take friction out of the system, it'll create more accessibility in the ability to participate in the system. I always felt that was part of the core thesis, but I didn't know how it was going to manifest. And there was two things that have really stuck with me. I'm sorry, I'm pivoting your question a little bit.
No, that's all right.
But the first one was, we started rolling out this ability for these mortgage lenders to now accept applications digitally and in a mobile way. And the very first thing lenders started calling me on was, hey, I have like the people who are applying for mortgages now are way like lower credit box type people. Way lower. And so what do we do? And they weren't saying it was as a bad thing. It was all of a sudden there was this flow of people who were interested in participating in the system that previously couldn't. And I think it kind of makes sense, right? So I think that if you're a mortgage company or a bank or whatever it is, it's not the top end of the market that's going to be benefiting from technology coming into a system and lowering friction. It's not even the middle side, because they'll be taken care of because somebody will be able to hold their hand and it'll be a profitable transaction. It's the lower end that wasn't profitable before that now suddenly has access to something that they maybe couldn't or wouldn't have done without that. And the other stat that I really like is we track kind of mobile usage and desktop usage. And desktop usage in our system is pretty widely used. It's like 70, 75%, and 25% apply on mobile, which is a lot. But the highest correlating factor to mobile usage is not age demographic, not ethnicity. It's income. The lowest income bracket is 3 times as likely to apply on a mobile device as a higher income bracket. And I think part of the reason is maybe that's the only device they have in their home. And part of the reason is those people who previously were shut out of the system and didn't want to go and talk, not shut out of the system, but didn't want to go and sit across the table from a banker, they didn't have a way to engage with the system before. And so, I love the idea of using creating platforms that others can we can add more data to it over time. We can improve the ways that we evaluate those people's credit over time. But first and foremost, we have to create a mechanism by which those people can engage with the system, and that's what Blend is. And so, we're maybe 1% of the way there. And so, what Blend does is every time we see an opportunity, we go out, as long as we have enough capital to survive, we go after those opportunities, and there's never been a shortage of opportunity in this space because there's so much friction still and so much wasted money and time and energy that is eventually costing consumers and potentially hurting the system long term.
So Melissa, let me ask you. So these guys are informally running nonprofits, but maybe one day.
Worse than nonprofits.
Yeah. Exactly.
That's a nice compliment.
Yeah.
That's kind of cute.
But so why did you decide? Yeah. Why did you decide a nonprofit was sort of the way to go? And what did you think? I mean, I talked to different housing kind of related, consumer credit related nonprofits all the time. What did you think was missing there that you guys saw an opportunity to do?
So one thing that I haven't heard either of you complain about are the regulations and the policy challenges that sometimes come up when you're trying to access or bring in new types of data, whether it's for identity proofing, the ability to, or inability or challenges of sharing data across financial firms in order to build the database. The nonprofit approach was something that was very early on without question, because what we're trying to do and what we are doing is being this conduit between policymakers and regulators who frankly often don't directly regulate non-banks in the financial space. That's typically done at the state level. So be this informing, honest broker between the financial sector and the innovators and the regulators, so that we provide the platform so that there is a level of testing, evaluation of how do these technologies work, but then also, as this honest broker, not-for-profit driven organization, we are then able to put together discussion, policy discussion issues that are, frankly, I would say at some level probably challenging for a number of these fintech companies. Issues around how does our Fair Credit Reporting Act, and that's the very big law that governs how information is used in a credit underwriting system, how information is actually brought into what is sort of legitimized as what's used in underwriting, but also for employment purposes and other purposes too. But how does that law allow for new types of data and information to be brought into underwriting? There are really important, critical questions that have to be thought about. Do we need to stay within the law that we have in place right now, or do we need to start to contemplate perhaps some new statute that recognizes both the value of bringing in new types of data, what we're looking at, cash flow, potentially other types of data too, rental data is another one, telco data, but also make sure that we're doing it safely and carefully. There are some really foundational questions when we're talking about new data flowing basically through pipes that are making their way into underwriting decisions. Where does the data come from? Who is ensuring that the data is accurate? What are we doing in terms of contemplating consumer privacy laws? So we, as this nonprofit honest broker, are able, frankly, to get enough of the industry stakeholders together to help be a part of literally an experiment and demonstrate what's the value of what they're doing, what are some of the potential risks. Frankly, we're able to do that because we're bringing in multiple, in this case, lenders into the experiment. And what we, FinRegLab, as this intermediary, report out is sort of an aggregated level. What did we see? What did we learn? While also then running these working group processes. FCRA is a big one. The Fair Credit Reporting Act is a big issue area. Another issue area that comes up that we all have to think about when it comes to lending are issues around discrimination, whether it's overt or what's actually, I think, more something we have to pay attention to with the use of data in underwriting. It's something called disparate impact. How does the data have an effect on who's getting access to credit and who doesn't? We have protected classes in this country, and we want to make sure that there is fairness in terms of how credit is allocated. And so all of these innovations are fantastic, but our rules have not kept up with what the potential value is and what the other considerations are. And so that's what we're setting out to basically facilitate a process around, so that we can ultimately help to move the policies, the laws, statutes if need be, so that we're striking the right balance in terms of the use of the technology and the data. It means that the regulators sit at my table when we have these tables. Being a nonprofit is the short of it.
Well, so I think I want to turn and talk a little bit. I think there are some people in this room who are really sort of deep, know everything there is to know about mortgages and credit risk transfers and all of that stuff. And then I think there are people who probably know very little about it, but I think everybody here has probably either got a mortgage or will one day get a mortgage. And something I have a really hard time wrapping my head around and getting people to answer is this question of like, is applying for a mortgage different today than it was 5 years ago or 10 years ago? And will it be different 5 or 10 years from now? Like, will I as a consumer experience it differently? So I don't know, Nima, if you want to take the first sort of crack at this question. Like, what impact is this really having on consumers? Is this changing their lives? Is it making them easier? Is it making it easier to get a mortgage? Tell me about that.
Well, I mean, I think getting a mortgage can change people's lives first and foremost. My parents got a mortgage 20 years ago, and it's the basis for their retirement right now. So I think fundamentally the housing finance system is really important to a lot of people like them who had no money saved up and wanted to get some sort of leverage in their future. And I think what's happened in the last 5 years is really foundationally. I think that there's been a big shift in what technology capabilities are available to banks and lenders to be able to give a mortgage. And so there's more and more digital, and there's more and more data. And the reason that the data is so important, and I tout data and not documents a lot, is that a lot of the information that's needed to approve somebody, what's their do they have enough for a down payment? What are their assets? What is their income? Are they employed, or do they have self-employment? What does their credit history look like if they have one? All of that information right now, the way it used to be done, maybe even 5 years ago, was somebody would submit a bunch of documentation, a consumer would submit a lot of it, somebody internally would read it, and then a week later they'd go back to the customer and say, hey, here's what I found based on your file. Which, that's the way it was to get a mortgage 5 years ago. What's happening now, and Fannie Mae is driving a lot of this, by the way, in housing finance, is people are saying, actually, there's a lot of data sources. We've heard about aggregators of different financial data, like bank data. We've heard about income sources, payroll sources, employment, TurboTax. Like, there's all these things, this data that's now digitally available, and that information can now be evaluated in real time to give a consumer a decision in real time. Like, I just had a lender who sent me they're running this real-time decision pilot. This was one of the bigger banks in the country, and they saw that their real-time decisions, their loans got ready to close in 4 days versus in the old way it was 12 days. And so, like, using data, it's a fundamentally different paradigm, and it enables people to get a better experience getting a mortgage. And it's not just people, though. It's just like, Fannie Mae will have a better understanding of the risk in that loan because they have the data, and they're not just trusting the lender to read and review that document. And then, the systemic risk, right? If you're going to sell those things in the secondary market, they are accurate. It's not a chain of reps and warrants that you have to deal with now in the future. And so I do think it's fundamentally different. I think where it's going in 5 years is probably pretty much everybody in the country will know within a few taps how much they can afford. Like, really, really afford. And that's really powerful, because if you're a consumer who maybe hasn't really understood what's available to you. I mean, had my parents not ran into this banker 20 years ago, our entire trajectory of our family would be totally different. And so the fact that now anybody will be able to engage with the system in a few taps is going to fundamentally change how, and now, of course, other things have to change too. Supply of housing has to change too, but it's going to fundamentally change how people engage with the system, whether people are willing to participate in the system, because there's less psychological damage that's caused by an onerous process.
So let me ask, are there risks to people kind of know? I wonder if there are benefits to people going through a process. It takes some time. I guess, one of the things that I worry about, there was a lender who was talking to me about this new fancy computer tool that they have that can tell you whether you should do a cash out refi, and you're not a disinterested party in that circumstance, right? But people will see it that way sometimes, and I wonder if you can talk about, what are, I guess, the risks to consumers of being able to get a mortgage in a second?
Yeah, and to be clear, I think that there's a lot of you make the technology so it could be done as quickly and low friction as possible, but then have responsibility and education and the components of the mortgage that are much harder to understand. Like, what does this mean for my future? If my rent is $700 now and my mortgage is $900, can I afford that extra $200? Those are different payments that you have to make. That's $200 is a lot difference. And so I think that the right answer isn't to put more onerous steps and confusing paperwork in front of consumers it's going to make the wrong parts of the population disengage. The right thing is to offer more and more education to those consumers and allow them to engage in the way that they want to engage. Some people will be educated, they won't want your help, and some will. And I think that if we're able to do that, then millions of people will be able to access housing that weren't prior to that.
Can I jump in on this one?
Yeah.
Education will get us so far. I think it does come back to these foundational issues of who's sitting essentially in some potentially fiduciary position as they're in a conversation with the consumer when we're talking about real data, real time, here are your two options. For there to be potentially some level of certainty about who is that person on the other side, what are their incentives, are our incentives aligned? I jumped in because I do think lots to figure out with the use of distributed ledger, but the notion that in the end, consumers can be basically sitting with their own picture, and whether they're doing their own analysis themselves about what their financial circumstances are, what they may be able to purchase when it comes to a home, or they're electing to go, let me find that for service fee advisor who then helps me assess that opportunity in that split second moment. I think that there are these benefits, there are these potential opportunities to the technology being combined with the real-time data, but it doesn't mean that we don't think about, now that we have so many other players and actors who are engaging in the offerings of different financial products and services, that we take our foot off the brake and trying to think about who's sitting with responsibility and at some level liability around that. I don't know if you...
Yeah, no, I mean, I think I agree with both of you, which is, I think it's a very laudable goal to actually increase the efficiency of delivery of financial services, because that actually does create new forms of access. So I think companies like Blend, Better, and others that are really doing a lot of innovation within the mortgage space, it's decades overdue, and part of that is because technology is finally available for that. And so companies like Spring Labs that can sort of be an aggregator in a highly secure way of data to enable sort of better decisioning and more efficient decisioning is really very pro-consumer. I agree with you, Melissa, though, that one really needs to understand, who's selling you on your product. By the way, that's true within the mortgage space, that's true within any investment product. That's why there's a whole discussion around fiduciary rule, which remarkably went away. But in any case, the whole notion of who has an incentive and what is disclosed to a prospective borrower or investor is a critical sort of question. I don't think, though, that changes whether we should want a much more efficient system, because I think efficiency really does drive access in many ways. But I do think that there needs to be both education and education around incentives, and where are we aligned and where are we not aligned, right?
Right.
And what risks are you really taking? The 700 to 900 is, not just, the 30% sort of difference, but it also the term of those payments, right? And how they might increase over time. And so that education and full sort of disclosure in what I'll call plain English or plain language is probably critically important.
Yeah.
So I want to pick that up, and I have a question about incentives. But before I ask that, I'm also supposed to remind you to submit your questions at the address on the screen, and you'll all kind of have a chance to ask these folks something. But I wanted to ask about incentives. And is the incentive structure sort of aligned in a way that if there are cost savings from this technology, that those savings get passed on to the consumer? Or are the sort of incentives more that the lender sort of ends up pocketing it, or someone else along the way?
No, I mean, I strongly believe that as friction comes out of the system, consumers are going to shop more, lenders will have to compete. This is a natural evolution of a market that's getting lower friction. I had a real estate, we work with a lot of real estate companies that have mortgage arms, and it used to be that your real estate agent was the primary referral mechanism for your mortgage. And they told me something that I thought was pretty surprising, which is that they've seen over the past couple of years, the number of people who show up with other offers in hand to their real estate agent in a deal has gone up 20% in the last 2 years. Not in like 5 years or 10 years. It's gone up in 2 years. It's gone up 20%. And so that trend is going to continue because we're making it so that consumers are really empowered with their own data, with access to their own data. They'll work with the companies that have the best products and the best service. And by making it a truly simple and transparent process, when it's all one tap, I think everyone wins. There's not just a bunch of waste and people in the middle who are taking huge cuts anymore of the process and hurting consumers ultimately, and maybe the whole system.
Yeah, I agree with that. But I do think we are at a really important point when it's thinking about what's the data that is useful to access, and making sure that the data is really the data that is necessary for making those decisions, whether it's comparison shopping or a competitive marketplace, that the information about the different options, about the different products, about what a particular lender would offer or not lender, that information is freely flowing. And I do think that there are movements afoot where we may see limitations on the type of data that flows. And I think, if industry itself can't settle that, it's worth thinking about how do we sort of contemplate sort of bigger expectations from a regulatory standpoint. Not that regs are everything, but, it's the ability for the sort of certainty of what are my options, what are my own circumstances. That is all dependent upon full information being shared. And does that get settled through agreements within the financial sector, or are there actual obligations that need to be placed on the financial sector that level of detail and information is able to flow?
Yeah, and there's some things in other countries that are being set up.
That's exactly right. That's right. PSD2, Payment Services Directive 2. Yes.
Tell us what that is. Yes.
I'll say about that much. So in Europe, in the UK, there had been a variety of government-led efforts, and actually now laws and rules in place that are requiring that data is actually flowing on consumer demand. And the way they've sort of pursued it in the EU is it's data that's flowing from the banks themselves to others through other entities. I'll stop there. I don't want to get out ahead of my skis on this, but it did in the end require the government itself was actually taking the initiative and mandating that information would be flowing upon consumer consent from existing financial providers, and in particular the banks. I think there's a little bit of caution and concern that maybe it should have been more expansive in terms of where the data was coming from, not just the banks that have to share, but other parties in the financial ecosystem would also have to share the level of information that is obligated on the banks. So we're looking and learning from what they're going through and contemplating what does that mean here in the US.
So Adam, let me ask you, I think reasonable minds can disagree at this point about whether credit is too loose or too tight. I think there are people on both sides of this question. But I think it's hard to disagree. It's hard to argue that we are just not seeing credit flow to minority households, to Black and Hispanic households, where the homeownership rate for those groups is pretty stubbornly low since the housing crash. What are the possibilities for making credit more accessible to those households? And also, how do we do it in a way that doesn't end up having the effect that it had a decade ago of, doing more harm than good?
Sure. That's really why we started this business, right? Which is we believe that technology is now available that can change the access equation. And as I was saying before, Equifax itself says that there are 26 million Americans who don't have any credit score whatsoever. And then there are an additional 19 million that have very stale data and therefore incredibly low scores that likely do not represent actually their creditworthiness. So this is this thin file issue that we was chatting about before. The most amazing thing is that there is performance data on those 45 million Americans, many of whom are underrepresented sort of classes of people. And that data exists in rental payments, in insurance payments, in your FiOS bills, in their Netflix payments, social media, et cetera. But none of that data, none of that performance data actually gets reported into any of the things that actually, end up creating a credit identity. So we believe that the technology, for instance, that we are trying to develop, that if we're able to partner with, folks that are at the nexus of the entire housing market, like Fannie Mae, that together we can actually crowdsource and incentivize this information flow. There are reasons we think we can do that, which I'd happily explain. And we think that that could actually allow the possibility of underwriting some of these 45 million Americans. And so we believe that technology can drive access, that technology is available today, And that really what it does require is a partnership between highly innovative companies that understand how to develop scale technology, and institutions, frankly, that sort of sit in the center of a market, such as Fannie Mae.
So, Melissa, I mean, algorithms can be biased too. Algorithms can, I mean, as you talked about disparate impact, algorithms can absolutely have racial, gender, geographical biases. How do we ensure against that?
Well, I think we need to test and learn. I think we need to realize, this is a little bit why I get enthusiastic about bringing in new types of data. I think we need to realize algorithms are biased when the data that is being fed into them is biased, and where we can be pushing and probing and bringing in new types of data that actually help to better nuance an individual's risk, where you're essentially pulling it away from what may be categorical types of indicators of risk, whether it's a gender, sex, race, even subprime category, frankly, even a FICO category. I think we can really potentially, at least our hypothesis is, we can start to better assess those individuals who otherwise would be cut out of the financial system and out of the credit access population. But I don't think we know how those data quite work until we actually bring them in and test them and look at them. Right now, we have 4 lenders on the consumer side, 4 non-bank lenders, who are sharing loan-level data with us, where we are literally evaluating similarly situated borrowers where they're scored with a FICO or a similar, or a FICO-like score, versus an assessment where cash flow variables, that data is actually brought into the assessment. And the first sort of question we have is, well, does the cash flow data better help you assess lift, right? Does it better help you sort the goods from the bads? The second order question is, does it actually result in certain populations who would have otherwise been turned down, especially protected class populations by gender, race, age? Do we see an increase in their yeses compared to what they would have gotten if it were just a FICO score analysis? And then ultimately, do we see differences overall between white men and any protected class in its totality? And then I think the next thing we ask is, looking within bands, FICO bands, and comparing white men with, say, a Hispanic woman, do we see similarities in outcomes, right? Because then we're controlling for these categories of risk. So testing and learning is a really important piece of this. I know we have this question coming up, but stating the obvious, we're looking at this right now in terms of small dollar credit. It's a foundational matter that we look at this over the long term. FICO has just come out with their own cash flow FICO score called Ultra FICO. They're looking for parties to potentially actually try that score out so they can test it over the long term. We're thinking about potentially testing cash flow data over the long term too, because it does have such potential important meaning and value, especially for the people who were so hard hit, African American communities especially, in the financial crisis. If we could figure out how to make sure that access to credit exists and it is available, especially around the really important assets around home ownership, that would be really foundational.
So we're going to go to Q&A in a moment. I'll ask kind of one more question off of that before we go to that. We're definitely, no matter what, we're sort of late cycle for the housing market. I don't know, maybe it'll pick up a bit in the spring, but there are clearly just signs. I mean, home prices have risen 3 times faster than incomes for years. There's clearly going to be some kind of an adjustment, at least some kind of period of flatness. How well do we know how some of these kind of expanded sort of models, these models are trying to give more people access to credit? How do we know how they're going to perform if the market turns?
Well, you just heard my answer.
Adam,
Gentlemen,
Nima?
how do you think about that?
I'm happy to. So we're not in the lending sort of business, but we were in the lending business, and certainly we use very sophisticated models when we were doing that, and we didn't actually use FICO. We actually used 200 variables that we sort of proprietarily acquired, and I'd say we hope that that modeling will be more predictive as we sort of move through this other side of the credit cycle. On the other hand, it does seem like, we're at the other end of that sort of credit cycle. And so I don't think it's necessarily the case that these new models are unlikely to perform well. I suspect they'll be more predictive than the older models, especially given the learning post-crisis. But it won't change the fact that, credit cycle is a credit cycle, right? Which is defaults are likely to rise and loss given defaults are likely to rise as well. And for the reasons that you mentioned, right, which is we've had quite an expansion in both the economy and certainly in the housing market vis-a-vis pricing.
Yeah, and I do wonder, it always feels to me like something like the sort of rolling out of ultra FICO. I mean, I wonder how coincidental that is with the fact that, lending volumes are way down, and you do kind of worry sometimes about, how much is good business and how much is good policy.
Well, I mean, 45 to 50 million thin file consumers is a remarkable market share to be going after. And if you could do it better with more nuanced information, more real-time information, not significant historical
information.
Look back, right, of credit payment,
Right.
but actually real-time information about what that cash flow picture is of a consumer. I'm optimistic. I do wonder. I think it will be especially meaningful for short-time small dollar credit. I think it's probably going to be quite useful for revolving credit. I do think we need to see it in performance in the mortgage space to understand what it really offers.
Yep, that's right.
So let me ask, I think this is probably a good question from the audience to throw to Nima to start. So this person asks, banks and lenders are filled with legacy systems. How much of a challenge will this be? Can we rethink consumer finance only in terms of the new, not merely adapting the old?
I think I would say we are thinking in terms of new. I think using data to make these decisions instantaneously and in low friction digital ways is new. I do think that these things are also built in a way that could be laid on top of the existing infrastructure, which is legacy. But I think I want to make sure we don't forget that there's hundreds of millions of people in America being served by the existing financial system. I don't want to just ignore those hundreds of millions of people. Those are some of them have huge networks, branches, in person. You talk about the education. And so being able to lay something on top of it, even if it's something completely new on top of something that, yes, was built maybe in the 1960s or 70s, it's fundamentally important. And if we didn't do that, I would worry that hundreds of millions of people would be left out and it would hurt the system. Or maybe it would happen eventually, but it would take 10 years to do this transformation instead of 2 or 3.
I think your point speaks to a really important piece of this too, which is we have the big banks that are partnering with, adopting, acquiring lots of the new innovative technologies, lending, pick your poison. But there is this also significant population of small institutions, and how are they able to partner with, take advantage of, adopt, acquire, I think is an important piece of how do we make sure the consumers of those institutions don't get left behind, and sort of what that equation looks like is an important piece of this kind of question too.
Who do you think, who seems to be having the most difficulty adapting? Is it big banks? Is it regulators? Is it Fannie Mae? Is it, who seems to sort of, who's the sort of hardest to sort of steer the ship in a different direction?
I think everybody's, maybe I'm optimistic. I think everybody's on board now. I think everybody's like, okay, we need to use data. We need to work with consumers. We need to be consumer first. I think everybody's on board now. I do think that being on this side of the credit cycle, I hope that this doesn't discourage the companies that have been on board from wanting to continue to make progress. That's my big fear about the credit cycle is like, if these things are 10 or 20 or 50 or 100% better than the old way, during a credit cycle, it's still going to hurt. And so making sure that people don't use that as a reason to pull back on their efforts in this space, because we have seen incredible collaboration across the industry. And I think that where the beauty of software as a service, the beauty of the modern technology stack, the beauty of the cloud is that a small institution can adopt technology the same way a big one can, and so that's pretty powerful. And I think millions of people will be affected positively by that.
Here we go. The Great Recession was driven in large part by subprime borrowers, the segment most likely to use these new technologies for access to credit. How have safeguards changed? I don't know, Melissa, if you want to take that to start.
That is, I'm questioning the premise, actually, that the
Or the
segment
causation
was
part of it.
using,
Right.
You're right, the new technologies for access to credit. On the other hand,
You can question the question. It's not mine.
but how have safeguards changed? I mean, like it or not, I think the ratcheting up of their credit quality expectations by the banking system, by and large, is in many ways the effort by the industry to really make sure that we're being as safe as we can from a safety and soundness standpoint. Are we being too overly cautious? That's what many of you here are here to talk about. And that's where we think the data may actually be a way to, I think this is critical, to prudently extend credit to consumers who can prudently manage it so that both the consumer is protected and the industry is protected at the institutional level, but also the systemic kinds of questions that arise from it. I mean, when you see the words "the Great Recession" and like, what are the safeguards? That's an hour-long conversation in and of itself.
I don't know, Adam.
Yeah.
What do you think?
Yeah, so I think that there have been a number of changes. Some of them have been, banks sort of, being much tighter around sort of their credit policies. I think there are very significant regulations that have been put in place that actually dramatically change the amount of credit that anyone can borrow. I also think that subprime, as a class of people, did not cause the Great Recession. I think a huge amount of misaligned incentives and mis-selling took place when you're giving mortgages to people that are larger than the value of an inflated priced home, where it's likely to, option arms effectively that were, very aggressive. I think that was more about the financial services sector's willingness to take vast amounts of risk because people had the wrong incentives. I think a lot of those incentives have been curtailed, but I think, and there's a lot more regulation, but I think to Melissa's point, I think part of this is utilizing data to provide access, but provide access in a very prudent manner. Can someone afford this, right, or not? And that really comes down to full and fair disclosure from your counterparty, from your bank, right? It's not the technology provider, it's your mortgage broker saying, finally you can actually buy a home. But let's figure out how much you can afford. Isn't it awesome that you can actually do this now, whereas before you couldn't, even though you're the same person, because now your data is sort of coming into the system. But that doesn't change the fact that you need to make sure that even if they are coming into that sort of system where they have the access to credit, that it's the right amount of credit with the right structure at the right rate. I think that's important. I'm personally a very large proponent of principles-based regulation. Which can be a little bit confusing. I used to do that when I was in London, and in the UK it's sort of quite common. And I think that formal legislation combined with principles-based, where you have to offer sort of full disclosure and fair disclosure. I think those are things that are pretty important. But again, it's not really about the technology. Providing access is a good thing.
Well, thanks so much to all my panelists. Thanks to you. This was a real challenging panel in the middle of the day, but I think we hopefully largely avoided jargon. And as a reward, you all get a 15-minute break now. So thanks so much to everyone. And we'll be back in 15 minutes.
Super. Thanks.